Okay, look, we might as well start the meeting. So could I formally welcome everybody to today's meeting of the Investment Subcommittee. The meeting is being broadcast live on YouTube, and it'll also be available for viewing after the meeting. Due to the current situation, this meeting is taking place virtually with members of the subcommittee, along with officers presenting reports joining online. Can I please ask all members and officers have their microphones on mute until they wish or are invited to speak. When you are speaking, please make sure your video is turned on. So if I turn to item 1, the minutes, I propose that the minutes of the meeting held on the 16th of October be taken as read, confirmed and signed. Is that agreed?
Yeah.
Agreed.
I'm just waiting for Adam to come online before moving on to 2.
Peter, hello there.
Morning, Adam. We just started. We're on just going through the formal part of the minutes. So we're on question time. I've received no questions. Questions asked by members under Standing Orders 7 and 7, and I've received no questions from members. Item 4, are there any declarations of interest? Sarah.
Thank you, Chair. Yeah, I need to declare an interest in item 10. Aegean run the technical term is they run the wrapper for the SIP and the an ISA I've got. But I don't think it's prejudicial. It's just they don't actually give me investment advice. They just run it on behalf of somebody else.
Okay. Thank you very much. I take it there are no other declarations. Item 5, the multi-asset credit update. Declan, the assistant. Sorry, I should say because of the recording. Declan Keegan, Assistant Director of Strategic Investment, will present the multi-asset credit update.
Thank you, Chair. So the multi-asset credit products featured in our strategy for a couple of years, and we've just been waiting for a central product to be developed before we can invest. We have got a sort of a small holding with JP Morgan, but to be honest, it's that small we don't really give it much attention. Hence, we wanted to bring a paper here just to start to, I suppose, give members a bit of a background to what this product is, because it is quite different to what else we've got in the portfolio. The targeted return is probably the most similar item, because in this multi-asset credit, the manager's got pretty much absolute freedom to move amongst the credit class to invest in different types of products. And it's it's been quite an attractive product, and the reason that sort of Hyman's included it in the strategy was that it's a diversifier to equities. Obviously, you can kind of keep pumping into the same place and just sort of exposed to kind of a sudden downturn. The yields tend to be better than normal kind of credit classes. Obviously, that freedom does give them that sort of ability to move around, and they do go into the sort of the higher risk sort of side of things. So they can go everything from sort of the steady products like government debt, corporate bonds that we already hold, through to kind of the sort of sub-investment grade stuff. And so they're kind of the key benefits, really. It's that diversification and that flexibility. So it avoids us having to do sort of tactical asset allocation on a sales basis. It's quite hard for us to react on a quarterly basis, even to kind of move between classes. So it's having that sort of dynamic manager. But the key thing to be, I suppose, aware of this product is it can be quite a risky little beast, and it's kind of, so there are a few sort of downsides to be aware of, and they're the sort of things as central development products, we're obviously asking them questions about, but when the decision comes, probably in a quarter or maybe a little bit longer after Christmas to invest, the sort of things that we need to be looking out for. And it's kind of, the first one is they're actually relatively new products, these sort of Max, this sort of flexibility, although the constituent parts may sort of be kind of a relatively well-trodden path. It's only really since the credit crunch that sort of asset managers have got into this. So you can imagine that the sort of track records are quite short, particularly of those ones that have been successful. There's not as many around, but it is a growing class. There's more and more getting involved in it. So it's not too niche, but it's not as common as the target returns or a standard equity manager. I touched on this. There is a higher risk. We are targeting a higher return than sort of something like corporate bonds, and that obviously comes with risk. So it's kind of sort of government. You've got the whole range where if they see the market being problematic, they can move into developed government's debt, but they're also going to be getting exposure into emerging markets and also into kind of companies that are kind of classed as sub-investment grade. So we do need to be aware of that higher risk. There is a kind of sorry, I can't read my own writing now. Yeah, it's not just the kind of the with equities, it's fairly straightforward. You know what you're getting into. You're buying a share in a company. With debt, it's not just that they're lending to kind of companies or governments, but they can do it in such a big variety of ways. So you've got, there's certain elements you'll be sort of familiar with, sort of securitized loans or unsecured loans or secured loans. So whether you've got that kind of, fallback if things start to go wrong with the company. But there's quite a lot of sort of fairly exotic products out there as well. You'll kind of come across things like, and the paper touches on it a little bit, things like convertible debt, where if the company doesn't repay the money, it actually converts into equity. So you get into sort of that, quite an unusual space. You'll hear of sort of hybrid type products as well, where it might be things like preference shares, where although it's termed a share, you're guaranteed a fixed coupon, but it kind of sits in between kind of equity, which is kind of, you run the risk of losing, versus debt, which tends to be a bit more sort of safe. So they can float in that space, and you'll hear all sorts of different things. You've got collateralized loans is another one, and you'll hear this quite a bit. And it should I suppose make your ears prick up a little bit, because when you hear about what a collateralized loans is, which is basically kind of lots of different loans being put into a pool, and then you invest a share of that pool. That's basically where the banks and the insurance companies got into trouble in the financial crisis, where they didn't really understand what was in that pool of debt. So you really are, if a manager is going to propose that they're going to invest in all these different products, we really do need to make sure that the manager knows what they're doing, because you can soon get into trouble. And it's a product that some of them we ask Hymans to kind of give them the once over before we invest, and this is certainly one where we'd expect them to be looking at for us, because it's kind of it is quite specialised. That said, it's easy to make these things sort of sound worse than they are. You can't get the reward if you don't take a bit of risk, and the central product does propose quite a lot of limits to prevent it being too much of a bet in one way. So it is limited how much they can invest in the more kind of exotic kind of elements of this. And the other key feature that should stop it being too sort of mad a risk is the target for the product is just LIBOR plus 4%. So basically, the Bank of England base rate is a reasonable proxy to get in your mind, just plus 4% on top of that. So it's the manager's not being expected to do too much. So you wouldn't expect them to go sort of too bad, but they are going to need to venture into some of the more sort of higher risk side of things, just to kind of boost that return above where you'd expect normal corporate bonds. As we do as the product sort of develops further, and Central are running the procurement process at the moment for managers, we'll kind of keep coming back to committee, just sort of make you aware of what's going on. But just wanted to give you sort of, I suppose, an initial flavour of the multi-asset credit, just so you can start to get your head around it. And like I say, just to flag it up, really, it's one that's a little bit less straightforward than some of the previous transitions we've done. So we wanted to just give quite a bit of notice on that. So happy to take any questions or thoughts on the paper.
Can I ask a question, Peter?
Please.
Yeah, thank you for that. When I read it and I saw junk bonds, Lehman Brothers came to mind in 2008. You say, but we're going to have more scrutiny over it. But would that reduce the return? If we have scrutiny, is it a bundle which produces, when I see you use the word junk bonds in the report, is it a bundle that produces 4.5%, or if we pick and choose, do we still get the same return? So
it's we don't pick and choose. So the manager will do that on our behalf. So they'll do that sort of active allocation across sort of investment grades through to junk. But their task is that overall blend should get us the 4%.
Much the same as Lehman Brothers did in 2008.
Well, they could invest in some of the stuff that, like say, Lehman's got into trouble. And it's like I say, these sort of collateralized sort of loans. It is that sort of thing. We need. you always hope the world's learned from what it did, but this is where you want to pick the right sort of manager who's going to be able to do it in a sensible way, that they take those things for a little bit of spice on the top, as opposed to being the thing that delivers all the return. And they're just sort of, you don't want too much volatility. You want them to be sort of hitting that 4% fairly steadily. But yeah, it is one to be eyes wide open, because people have made a hash of this in the past.
Yeah, they have indeed. Thank you very much. Thank you.
Tom? Tom, I can't hear you.
Okay, can you hear me now?
Yeah.
Can you? Yeah. Okay. Declan, I fully understand what you're saying. The sort of return we're getting at 4%, I fully appreciate that returns are awful at the moment, but bundling up loads of collateralized loan obligations, you pointed out the risks there. One wonders, is the benefit that great compared to other products? I mean, I know 4%. Is it worth taking that risk?
And I think that's a fair challenge, and what we need to kind of, I suppose, get into a bit when the proposal does come forward. But the response from the manager should be on the lines of, actually, those collateralized loans, they may not even touch them, to be honest, but it's just that, it should be a small portion of the portfolio, maybe 10%. And it's just that counterbalance. So the core of it should be around government debt, corporate bonds. So, but that's the sort of thing we do need to get into when the manager are appointed and they come back about, well, how they're going to do it, because it is exactly that. Is it actually worth all that effort? Because if it's too volatile, why do you? But that's the theory anyway. It's just trying to nestle between what you'd normally get from debt, but it's not as volatile as equity, and that's for them to show.
All right. Thanks, Declan.
Okay.
Sarah?
Thank you, Chair. Sort of following on from that, what's going to be the next collateralized debt obligation? And I get the having a broad range of investments and nothing's going to sort of dominate it, but I guess it's going back to what you were saying. Picking a manager that can explain some of these, particularly more esoteric things, in a way that makes us comfortable that we're not going to be involved in the next Lehman's. Somebody can invent something else that is equally crap underlying fundamentals, in a better expression. See where I'm trying to come from? Is that time? What might it be next time?
Yeah, no, I do absolutely. And part of Central's kind of work when they're appointing managers should be understanding their investment process and the kind of what they do. And Central, in truth, they're much better set up than we ever were in terms of actually being able to get close to managers on a regular basis. And it is one of the red flags that comes up in their regular monitoring, that actually suddenly they're getting into something that they didn't normally do, that wasn't in the sort of strategy. So that the performance hasn't always been great on sort of some of the stuff that Central's done around the sort of the global and emerging market. But in fairness to Central, what they have been very good at is being close to the managers and being able to see actually what they're doing. So I think it's a fair challenge what you say, that they kind of, it's a real Warren Buffett sort of quote into that, only invest in what you understand. And it's kind of so that the manager should be able to explain to people like yourselves what it is, because otherwise you question whether they really understand it. But we do need to push Central, and again, it's a fair question. Central are being paid on our behalf to make sure they're managing that process and keep it away. And the limits in the mandate should help in that it keeps them away from it. And like I say, they're only being tasked with 4%, so they shouldn't be wanting to put their reputation as a manager too much on the line for that sort of return as well.
Okay, Nick.
Yeah, thank you, Chair. Two things really. One is, you will, on these kind of arrangements, have investments that go bad. It's making sure that the exposure to that one individual type or individual investment doesn't send it way low, effectively making a negative return overall on the fund, which is the key part. The other question is, what would be the charges on this kind of investment?
So the charges is harder to sort of say. If you look at our targeted return type sort of products, it tends to be about the sort of 0.75% of a single percent, and it's likely it's more going to be in that sort of range than kind of the 20-30 sort of basis points that we've seen on the equity, just because you're expecting the managers to do that active management. But that said, Central have kind of the fees that they've been getting from the manager have probably been lower than we've been expecting. They've been able to get sort of more out of it, because in investment management, if you've already got a product set up, it's all the new assets that you get in there, it's just money dropping to their bottom line, really. So the guess would be that it's probably going to be more than 50 basis points, maybe up to sort of 60, 70. But because we haven't seen the details of the procurement yet, we don't know. But that'd be the expectation. In terms of your other point about kind of, I suppose, betting the house on too small a number of things, the limits in the mandate is no more than 5% in a single kind of product at the moment. So in theory, you could have it sort of spread over 20 different things. My guess is it'll be much more, because you're not going to maximise everything. So that's the way they've done it, with a little bit of sort of mandate control in there as well.
Okay, Nick. Bulesh.
He doesn't get to ask me questions.
No, it's not a question. I was just going to add that the limits that we do have on the esoteric types of investments within MAC are limited. Our total portfolio can only have a 4% allocation to MAC, and on top of that 4%, only a percentage can be within the riskiest parts. So if you consider, we might only have 10% in the riskiest parts of that 4%. So over the whole fund, there shouldn't be a huge impact at all. And whilst we're developing the MAC fund with Central, officers do have the opportunity, and we have talked to them about where we want to limit exposure. So, it's not left to the managers to decide. We kind of decide what the mandate should be shaped like.
Okay. Declan, I tell you what does slightly concern me. Because this is a public meeting and it's available to anybody to click in and watch. If you were the man on the proverbial Clapham omnibus who had got a pension, and you said to him, do you want to put part of your pension at risk in some of these rather esoteric assets? I think the answer probably would be no. And so I think there is a gap between the multi-assets that, as we started out, Melise pointing out, everybody remembers what happened to Lehman's, and saying history can't repeat itself, but that's just not true. And there is a gap between credibility of the chap on the London omnibus saying, but it's my pension and I don't want to put things at risk. On the other hand, you're charged with trying to maximize the returns, but you've got to be able to make it in a presentation that makes somebody comfortable with what you're doing.
Mm-hmm. No, I think it's a fair challenge. That sort of, it's public money that we're playing with here, and ultimately, if you get it wrong, it sort of goes, it's the public purse has to pick it up, whether that's through sort of education, social care, etc. So it's I suppose the broad responsibility. I mean, Bulesh touched on some of it. It's kind of this type of product tends to sit in a sort of small corner of our kind of portfolio. The bulk of what we do is kind of passive trackers in equities. We've got quite a lot of sort of stabilizing assets in kind of infrastructure property. This is really just to kind of, I suppose, help nudge the returns of the portfolio on, and in truth give a bit of diversification as well, so you are getting that spread of classes. I suppose the other pieces you touch on is kind of it's a fair challenge, and this is where sort of Central and the managers have to be able to show that actually it's a product that you as a subcommittee are comfortable in investing into. It's kind of at the end of the day, it's just a proposal. So Hymans believe it's a good asset class that sort of stacks up on that risk reward basis, so that it's getting harder and harder to find return. That if everything was sort of stuck in kind of really safe kind of corporate bonds, government bonds, the burden on us as employers to kind of to fund the pensions would just go up and up and up, because the pensions are particularly sort of generous in LGPS. And I suppose the other piece you'd say to the man on the omnibus is that kind of actually it's a defined benefit scheme, so he'll get his pension come hell or high water. This is more about the employers, and the employers trying to balance that kind of a significant benefit that the employees get with the affordability for an organisation. So it is difficult, because people do feel that it's we're taking a risk with their money. The reality is we're risking the employer's money. So it's kind of fortunately, most of the employers are kind of represented here, so they can say, actually, is it a risk they're prepared to take on? But I do remember the reason we're kind of, is a riskier end of things, but it is just a small corner of a strategic asset allocation.
Okay. Does anybody else have any comments or questions to Declan? No? Okay. Thank you very much, Declan. You're asked to note the report. So do I take it that's agreed?
Noted. Yep.
Noted. Thank you very much. Moving on to 6, the next item is the recommended investment. The Adam Street Partners Private Equity Fund and JP Morgan Infrastructure Fund. They're set out on the agenda on the pages 11 to 36 in your pack. This report is supplemented on the exempt part of the agenda, where you will consider the recommendations. Declan, you're making a presentation of this report.
I think I've got this one, Chair.
Oh, right.
Yeah.
I'll crack on. Okay, so the purpose of this is to consider an investment into Adam Street Partners Private Equity Fund and an additional top-up investment to JP Morgan Infrastructure Fund. We hold both currently, so this is just a top-up. We're just running quickly through the paper. The fund does currently have, as at September, so last month, about £110 million in cash. So we're keen to deploy that in areas where we deem there to be opportunity. The fund is cash flow positive, so whilst we do nothing, it is always accruing cash as we move along. The rest of the paper does outline how we want to deploy the cash. There is a table in point 4 which shows our current target weights for each of the major asset classes. In the first column, shows where we are as at June, and therefore the difference to that strategic asset allocation. And in the planned action and the remaining variance, you can see the kind of actions we want to take to try and minimise those differences to what Hyman's define as our target weights. So we're proposing a £45 million allocation between the two, JP Morgan and Adam Street. So it's split private equity with Adam Street 20 million and JP Morgan Infrastructure Fund 25 million. So if we first talk about the Infrastructure Fund, we've got circa 400 million in infrastructure already. We do have 4 funds with 4 managers, and they form part of the real income allocation, which is generally around inflation protection and long-term stability. The last asset allocation review said that the infrastructure weight should be 9.75% of our total assets. We're currently around 8.7, so we're about 1% short, or 50 million. We're looking to address around half of that with this top up, and we've got the rest of that shortfall to be administered when Central launched their infrastructure product, which we've committed to 25 million on already, pending due diligence, of course. Point 6 looks at the 4 funds that we have currently. So just to point out, we've got top of that table there, we've got JP Morgan's infrastructure fund at 92 million. We've got IFM Global Infrastructure, which is slightly higher number in there, 105 million. We've got KKR, which important to note, we've got a small amount in there. It's a closed fund. And we've got Stafford Timberland, which you'll probably be aware of, is our investments in sustainable forestry and timber. Again, it's a closed fund. So of the 2 that we do have options on investing within, that's the JP Morgan and the IFM. They're both open, meaning that we can add new money to it, and they just roll on. They don't return money at any particular point. So we were looking at those 2, and we went through the paper, and we've decided on the JP Morgan IFM fund. For a number of reasons. We've got a slightly smaller number in there. They've returned income, and we can do what they call a top-up investment or a re-up, where we just fill out some forms and we can invest with a delay. There's a 6 to 9 month delay before we can get money in, but if we commit now, then we'll be ready in 6 to 9 months to get the money in. Just pressing on to point 11, just some information regarding what the JP Morgan fund does. It does return 5 to 7% in income. So based on our current holding, that's about 5 to 6 million per annum. For those members who were at the last committee meeting, they had a presentation and they came across quite well, and they presented on their strategy. You'll notice that is also included within the paper in one of the appendices. The JP Morgan fund does also have a lower management fee. It seems to be more safe and more defensive as a portfolio, and therefore, another reason to pick that ahead of the other open fund. Just coming back to what I said earlier, point 14, that we propose a £25 million investment, so we'd expect that to be probably invested or put to work by JP Morgan middle of next year if we sign up to it now. Number 16, moving on to private equity. The current allocation is mainly via Adam Street Partners. We've had a long-standing relationship with them. I think we've probably first invested with them back in 2002. We've got two options here at the moment, really. We've got LGPS Central's private equity offering, which hasn't really got off the ground yet. They don't have a head as of writing this paper. They have just appointed somebody, so they do now have a head of private markets. We did commit a small amount of money with them the year before last, but as it stands, we're looking to maintain what we call vintage diversification, so putting money in small chunks into every vintage. So this would be the 2020 vintage, and it takes a number of years to get this money invested. So this 20 million doesn't fully get called on by Adam Street and invested in year one. It takes 5 to 7 years to get it away. So that, the reason behind having a good long-term plan behind why we put money away now, because we know that money's coming back off them from all the investments we've made over from 2002 onwards. We did, just for information, about this time last year, the subcommittee invest $39 million in the 2019 fund, and at present, just 8% of that has been called. So that kind of demonstrates the longevity and time it takes to put money to work. Point 21 just goes back over the fact that the alternative with LGPS Central at the minute they've just appointed a head, and we want to understand what his strategy would be before we commit to any further monies with them. Appendix B does also include Adam Street Partners ESG factors within their investment process, so keen to point that out. Moving on to 23, which is why haven't we considered anywhere else to invest at the moment? So we are underweight in property by circa 1.6%. We're not considering anything at the moment other than the fact that Colliers have been instructed, Colliers are our direct property manager, and they have been instructed earlier in the year to try and close that gap for us. So some information at the moment, they are investigating a number of opportunities which may or may not come to fruition, but they are looking to progress those. So we're kind of happy that they're doing some work for us to try and close that gap. On top of that, we know Central are looking to launch a fund Q1 next year, so we should have opportunity to close the gap further then. So we don't propose any action at the moment, but steps are being taken to close that gap. Point 24 just notes the kind of things that Colliers are looking at to get into. So they are looking at an industrial warehouse and a supermarket, both areas that we don't have in the fund at the minute. So should provide a defensive kind of tilt to our returns and a bit of diversification, given we don't have either at the moment. And that's all I've got at the minute. We'll like the chair said, we've got a supplementary paper to discuss the decision in private session. Any questions?
Okay, if there are no other questions.
We've got one question.
Oh, sorry, Melise, you've got a question.
Just on the global fund, we have only invested 92% of last year's allocation, and we're allocating more. What happens to the uninvested money?
So the uninvested money gets called when they find investments. So they expect to put all the money to work over 5 to 7 years. At the minute, they've only put 8% of that from last year's allocation. So, they'll be calling on that as time goes on. And at the same time, the investments that we made from 2002 onwards, they're all rolling off and distributing money back to us.
But are we keeping that on
Yes.
sort of what I call short-term money at minimal interest in the meantime?
That's right. So that's part of this. So we currently have about 110 million sitting in short-term investments, so near cash, so earning very little at the moment.
So is that taken into account with the return? I mean, if we're going to have to sit on no return that money for a couple of years, we're going to want to have to make it up in quite a major way when it is invested, don't we?
We do. I mean, we shouldn't be sitting on too much money as a fund, which is part of the reasoning behind putting this money away now. And we've got a number of funds that are coming up with Central. So we've got a property fund that will take up some of that 110. We've got an infrastructure fund that should be ready by the end of this year with Central. That'll take up some of that money. And they're the two big ones at the moment. And any investments that Colliers will find will eat up some of that money.
All right, fine. Thank you.
Are there any other questions for Bulesh? No? Okay. Could I thank you very much, Bulesh? What we'll do is we'll consider the supplementary information and recommendations in the private session after the open part of the meeting. Right, you've got dates of the future meetings running through next year. So for those of you who aren't councillors are not standing, maybe you need to question whether you need to put all of them in. Anyway, the one that you do need to put in is the next one, which is the 16th of December. Okay. We'll then move on to the exclusion of the press and public. So formally, may I move that in accordance with the Local Government Act 1972, the public be excluded from the meeting for the remaining items of business on the grounds that they involve the likely disclosure of exempt information.
Agreed.